Hi there. Thank you for attending today's webinar. I want to first introduce the two fantastic speakers that we have today for today's webinar. First of all, I've got Dan Lesser. Dan, wave your, well, everybody can see your name underneath. Dan is president and CEO of LW Advisors. He has more than 40 years of experience in the hospitality industry. I can tell you personally, I know he's an international authority and thought leader on the hospitality industry, and he's a columnist for lots of papers. And so anyway, very, very pleased to have Dan. He's going to give us a little bit of insight on the hospitality industry and what the future, in fact, I understand he knows what the future looks like here. So I'm really anxious to hear this. Also have Barney McAuley. Barney is the managing director at Edge Capital Markets. And Barney has spent his career in acquiring, turning around, and selling underperforming loans. And I think you have a heavy concentration on malls and retail. And boy, that's a challenging property type right now, too. So anxious to hear from Barney about the retail segment of our industry. And I can tell, and I'm Ann Hambly, by the way, founder of First Service Solutions. I'm working with hundreds of owners right now to get relief for their properties and their loans due to COVID. And I think the biggest challenge we face right now, and the one thing we know for certain, is that nobody knows what the future looks like. And unfortunately, that's one of the biggest things that servicers need to understand in order to grant relief. So with that, I'm going to turn it over to Dan, and he's going to give us again some insight on the hospitality segment of the market. And as usual, if you have any questions, be sure and type them in. If anyone can't hear us clearly, I just got a note that someone said they cannot hear us. If you have trouble hearing, or there's any message you need to give us, any questions you have during the webinar, please go ahead and type them in, and we'll take them during this. But with that, Dan, I'm going to hand this over to you. I understand you have a great slide deck. I can't wait to kind of hear your presentation. So thank you, Dan.
Thank you, Ann. I'm really flattered to participate with you and Barney, and greetings from New York. So I'm going to try to go through this fairly quickly. You know, the lodging industry is reeling at this point. Maybe not as bad as retail, but almost as bad, if not worse, quite frankly. And I think the cover slide, you know, sort of says a lot in terms of we were at peak beginning of this year, and then come end of March or April, we went into free fall, hit a bottom, and we're sort of bumping along slightly above the bottom. And for those of you that were around in the early 1990s, during that downturn, the expression then was stay alive till 95. So I've now incorporated that to stay alive until 2025. Okay, so let's just take a real quick minute, talk about the basics of hotels. They are very unique forms of real estate. The fact is that they're going business concerns married up with bricks and mortar real estate. There are no credit tenancies. There are no long-term tenancies. If you think about it, with technology being what it is today, pricing of guest rooms changes by the nanosecond. That's a beautiful thing in a rising market. It'll kill you in a declining market, as what's happened in the past couple of months. Very, very compounded complexity in terms of the way deals are structured. You have a whole bunch of different parties that are in an investment that don't necessarily have all interests aligned. Very highly leveraged fixed cost business. And if you think about it, a lot of reliance on intermediaries, right? Hotels located on islands, think Hawaii, think Puerto Rico. You know, without airlift, there's not too much of a lodging industry. So the bottom line is to sort of remember, this is as a backdrop for our conversation, that the hotel sector, it's very complex, and frankly, it's a volatile business. So, you know, just taking a moment to consider, prior to March, call it March 15th, the U.S. lodging industry was on a record rise, and for close to 10 years. And while the metrics, the growth in the metrics was declining during the past couple of years, it was growth nonetheless. Profits, all-time highs, in 18, again in 19. And then, frankly, in January and February, we hit even more new records, right? And then come March is when it just fell off the cliff. And this is just a graphical example of occupancy. These are national statistics by month, beginning of January 20 of this year. Average daily rate, and then RevPAR, which is the simple calculation of occupancy times revenue per available room. And we can see how it went off the cliff in April, and it's sort of slowly coming back, and it's taken a bit of a dip after the summer when a lot of people traveled. So again, revenue per available room, revenue times occupancy. We bottomed out at an 80% decline, compared to last year, 2019. That's an astonishing number. What's interesting is that when 9/11 occurred and the great financial crisis, the sector endured declines in revenue per available room of 20-23%. And when those occurred, those were, oh my God, moments. These are unprecedented times. Well, it's kind of interesting because if you compare the 80 to the 20, obviously, there's a huge difference. And then what's even more interesting is that, we're now bumping around, call it 50% decline compared to last year in revenue per available room. And many in the sector are actually excited about that, which is, understandable when you compare it to 80%, but still, nonetheless, double bottoming out during the last two downturns. So these are, again, are very unprecedented times. This is just another graphical example of how revenue per available room declined, bottomed out at 80%, and again, sort of bumping along at I think we're now back around 50%. Definitely been a sharp increase in deferred and abandoned projects. I think it's safe to say that any project that pre-March 15th was a dream in somebody's head is not happening. For the most part, I think it's also safe to say that whatever is coming out of the ground will most likely open up. But we're going to see a real big slowdown in new hotel construction, which is not necessarily a bad thing. This is an interesting slide that shows and sort of proves the point about volatility. The hotel industry is known for dramatic highs and manic lows, and we can see that comparing 2019 actual to what's forecasted this year, the metrics are horrific, right? These negative numbers, whether it be demand of 39%, occupancy 40%, RevPAR negative 52, right? But then the forecast right now for 2021 is quite a dramatic bounce back. Now, that is a forecast, right? But the point of this is, again, to illustrate the volatility. And frankly, some people who are not necessarily focused exclusively on the sector have trouble believing during good times, if you will, that hotel values can actually increase year over year, upwards of 20, 30, 40%. And just like they can decline 20, 30, 40% year over year, they can rebound that quickly as well. Again, just another illustration, but what this does is tell us that the former darling markets in America, the top 25 urban 24/7 markets that traditionally had fairly high barriers to entry on a long-term basis, were really the go-to investment markets for hotels. They're taking it the worst during this pandemic. The New Yorks, the San Francisco, Chicago, Boston, et cetera, et cetera. And the secondary, suburban, and tertiary markets are actually obviously taking a hit, but not nearly as bad as the urban core 24/7 markets. In terms of recovery, it's really going to depend on market and type of demand, right? And this is a pretty illustrative chart of what's going to happen early in, and we're already seeing it happening, that folks are traveling by car. And then, as we get into the later recovery, which we will get into, the big question is, when is it going to actually occur? International air travel, we're probably quite a ways off from that. Profitability, it's, again, everything's relative in life. These are horrendous statistics on the negative side, but we can see that as time is going on, here we are in October, and the amount of decline in profit is decreasing as time is going on, and hopefully it'll continue to bounce along until the spring, when I believe there should be hopefully a dramatic turnaround by that point. And we can see here that the anticipation in general is that we don't get back to 2019 before 2025 at the earliest. Again, this is a forecast. Happen sooner than that. It may happen later than that. But very interesting how the decline was so dramatic, so swift, wide, deep, and yet it takes 5 years to get back to where we were before. So when we look at the transaction market, Q2, the bottom fell out. And I track trades of $10 million or more, single asset trades, not part of a portfolio, with no allocation of pricing from a portfolio. And when you look at Q2 2019, there were 35 trades that fit that category, totaling $2.6 billion, average sale price of $286,000 a room. Compare that to Q2 of this year, 6 trades, $246 million, average sale price $169,000. And then on the far right, I mean, the statistics they speak for themselves. Dramatic decline in transaction activity, dramatic decline in average sale price per key. Then we go to Q3, which is very interesting in that compared Q3 this year to last year, again, dramatic decline, not nearly as bad on a percentage basis as Q2. And if you want to spin this positively, there were 12 trades that occurred in Q3 of this year compared to 6 in Q2, so it doubled, right? What is also interesting is that the data showed average sale price per key for Q3 this year compared to last year actually up 8%. And there are several reasons for this, and we're going to explore that. This is an illustration of the trades that occurred in Q3. Some real significant assets. The Viceroy L'Hermitage in Beverly Hills, trading at, if I recall correctly, over $800,000 a key. There's been some very, very, nice, robust pricing, not that many transactions. Q4, as of yesterday, we now are at 18 trades thus far this quarter. So we've already exceeded far exceeded the 12 that occurred last quarter. And 1.6 billion, again, double the total transaction volume from last quarter. So it's moving up and definitely getting more active, slow, but definitely, again, transaction activity is increasing. These are a handful of trades over $100 million each, some pretty significant assets. The Hotel Commonwealth in Boston. And then here are a whole slew of Q4 major sales thus far this quarter, under $100 million each. What's interesting is that there's been a fair number of trades in California of properties that are being purchased by local municipalities for permanent housing for homeless folks. We're actually seeing that happen in other parts of the country as well. The Sheraton in Wilmington, Delaware, is another property that was purchased for that purpose. The Hotel Diva in San Francisco. So, we're seeing a lot of that occur, and frankly, the numbers that these things are trading at are market. They're not being sold at wholesale discounts. So everybody always wants to know, what's the decline on value, and it's presumed automatic decline on value pre-COVID versus post-COVID. Excuse me. And I remember, a couple of days after, the pandemic really became a thing, and folks were out there pontificating, 20 to 40% decline in value within a matter of days. And I always kind of scratch my head a little bit, because this is what I do, and I've been doing this for a long time, and I love it. And I had no idea that was the range in decline of value. I didn't know how anybody else knew. There was no empirical data. So here we are now in December, and there's a bit of empirical data. The transaction on the upper left-hand corner, Sunstone sold the Renaissance Baltimore for $80 million. I will point out this is all public domain information. I also know that some of it is not necessarily 100% accurate, but the information that I'm aware of is confidential. But for the most part, I think we can look at this and get a pretty good barometer. Pre-COVID, Sunstone reportedly had a deal for $100 million on the Renaissance in Baltimore. So that's a 20% decline, right? Lower left-hand corner, the Embassy Suites in Manhattan, that traded 18 months after Ashford bought it. The differential there is about 41% decline. So 20, 41. And then what's real interesting is the one in the lower right-hand corner, the Waldorf Astoria in Chicago, which sold remarkably at $54 million. It's amazing real estate, quite frankly. And that's about 52%, 55% off what the last group bought it for just a couple of years ago. 50% decline. So there you have, 20 to 50%. Pretty wide range. Doesn't mean every asset went down somewhere between 20 and 50. It is possible for an asset to only dip in value, frankly stay flat or dip, or maybe even rise. So this is an interesting trade. Amazon acquired this Ritz-Carlton in Pentagon City for $148 million, and it sold a year earlier from Host Hotels and Resorts to Blackstone for $99 million. And when it sold to Blackstone, HQ2 was fully baked. The whole world knew about it. Nothing really was unknown at that point. And here we were, just a year later, and Blackstone baked in nearly a $50 million gain, or 50%, 50. So that's part of the reason too why you saw the average price per room for that quarter increase a tad. I'm closing in here on the end. This time has during COVID, when I've been pretty good about hanging out in the bunker, it's given me a chance to sort of contemplate oh my God moments in life, at least in my memory. And I can remember as far back as the Cuban Missile Crisis in 1962, back in the days when we had black and white TV, 9 channels that after the 11 o'clock news, we actually had news back then. And after that, there was no more TV. And, the talk about the United States being on the brink of nuclear war with the Soviet Union at the time was pretty frightening, and definitely an oh my God moment. The Arab oil embargo in the mid 70s, Americans were standing on line on even and odd days for hours when they were allowed to stand online to get gasoline. The stock market plunge of 87, 500 points. I remember that vividly. That was an oh my God moment. I mean, today 500 points is nothing, right? Desert Storm, 9/11. It goes on and on. The point is that when you look back at crises that the world experiences, that the United States experiences, that appear when they happened and shortly thereafter to be oh my God moments, every time we come back bigger, better, and stronger. So just a couple of random thoughts. I'm not a big fan of the inning analogy. but I think it is fairly safe to say that at this point we are in no more than the first inning, and perhaps the bottom of the first inning of a recovery cycle. Smart sponsors who can are taking advantage of depressed travel conditions and renovating properties now because they're empty. It is interesting, motels, which are for the most part roadside exterior corridor properties, have been perceived as functionally obsolete product for a long time now. And, given today's environment, they're actually not as obsolete from a perception perspective as they used to be. Not sure how long that's going to last. We talked about hotel construction is definitely going to come to a screeching halt. At the end of the day, it's going to be nearly impossible to get construction financing. Long term, I really do believe long term, well capitalized, opportunistic investors that bet big and at the right basis and early in the cycle are going to hit it out of the park. The air is out of the tire. There really is not a whole lot more downside in the sector. There's only upside. It's not a question of if, it's when it begins, and then what is in fact the duration to get back to where we were. The last point, distressed deals are coming. There's no question about it. But what everybody needs to realize is that there is an inordinate amount of capital in the market chasing yield for all types of assets. And within that sphere, commercial real estate, drilling down further, hotels. And, there are going to be an awful lot of opportunities. We've already seen them come up of unique potential acquisitions. L'Hermitage, as an example, right? Those are, once in a generational opportunity to purchase. And those assets that have compelling turnaround stories, there's so much money out there, those opportunities are ultimately going to get bid up. So you will have distressed transactions, but they're not all going to necessarily represent distressed pricing. I think at this point, this quote from Winston Churchill is fairly appropriate. If you're going through hell, keep going. That's kind of how we feel like, at least it seems like to me, what we're going through. I hate to end on a negative note, so here's a little bit of inspiration. This woman, this is just reported last week, this 102-year-old woman, she lived through the Spanish flu, and she just survived her second bout of COVID-19. Wow. So on that note, Ann, I thank you very much. I appreciate the opportunity, and I'm here to answer any questions or just hang around the hoop. Thank you.
Well, stick around because there will be questions, I know. I think so. One of the things that's interesting is the fact that we are in a recovery. We're in the first inning of the ball game, so to speak. But you're predicting, or you're hearing that it's going to be till 2025, right? We have to stay alive and keep walking through. So that's pretty amazing. And Barney, I'm anxious to see, I think we all are, but is retail on the same exact kind of trajectory? Are we all in the recovery mode on retail now?
No, we've got a ways further to go down. But retail's like hotels, and Dan and I talked about this before, retail's made up of different segments that have been affected differently by the pandemic. In this presentation, I'll try to show how the pandemic has affected different segments of the retail industry and what the different futures look like in the different areas of retail. Before we go too far into this, we're talking about dollars and cents and what effect this is going to have on investments and investors, loans. But this pandemic has been horrific, and it's killed well over 200,000 people, and 30 million people are out of work. So as we go through this, we're talking dollars and cents. We don't forget the human side of this pandemic and what it's done. Big picture retail, it's had a terrible negative effect. There's over, close to 20 million square feet of negative absorption. And it looks like it's going to be 4 times that before we start to recover. Now, for folks that have only been in the industry for 10 years or so, you might not know that term, negative absorption, but it's a bad thing. It's not in any product type. You do not want, you're supposed to be absorbing space every year and constructing space every year. Negative absorption puts you back a long ways. That said, not everything in retail is negative. there are certain sectors of the retail market that are stable or actually increasing in value through the pandemic. Over the last 10 years, single tenant net lease properties have doubled in their attractiveness to investors. This is caused by boomers, such as Dan and myself, wanting to get out of the real estate industry, getting frustrated with running a fourplex in San Diego and all the problems they have from their tenants, and saying, let's sell this, take our profit, and buy a Chick-fil-A in suburban Dallas, and we'll just clip our coupons and collect checks. This Chick-fil-A got over 30 offers. The eventual trade was at a 3.9 cap. There were financing options available below 3%. So it provided a good return, taking into account the 1031 exchange. The strategy behind this is very simple. Chick-fil-A is a great tenant with really good credit, and they provide a product that has just actually been in more demand during the pandemic. And the drive-through nature of it fits with the pandemic. And so people still want to invest in real estate, they still want to invest in retail, but they want to just invest in the most secure part of retail and still get a better return than they can get on T-bills. So some of these prices have gone up on the single tenant deals, and we expect this pricing to stay stable, or if there's a change, it's going to come out of Washington. If the new administration decides to adjust the rules on 1031 exchanges, that will have a negative effect on these values. But we do not expect special servicers to be very busy with 1031 properties in 2021. It's going to be an area that they're not going to have to spend a lot of time on. Grocery anchored centers are also a bright light in the retail industry. If you have a Whole Foods anchored center in suburban Boston or suburban Atlanta, and you don't have another box in your center or a lot of inline space, you're going to get a substantial amount of offers. Grocery sales are way up through the pandemic. Before the pandemic, 51% of meals were eaten outside of the home. It got to over, and then it dropped to only 20% of the meals eaten outside of the home. So the grocery stores are cranking. And if you're in a real estate fund and you need to allocate 15% of your funds into retail, you're going to be buying centers like this one pictured. Cap rates are down 6 and below. They haven't moved up through the pandemic. The lenders that are readily available to provide you debt on these types of product. And so when we see these centers trading at attractive pricing and stable pricing through 2021. Again, this won't be an area that the special servicers will be spending a lot of time on. Power centers were in trouble before the pandemic. Many retailers are right-sizing their portfolio. That means they're closing stores or they're taking stores and cutting them in half because they're doing so many sales on the internet. So they realize they do not need as large a store as they needed 5 years ago. So their lease term comes up, and Burlington needed 60,000 square feet 5-10 years ago. Now they need 25. So that it'll be very difficult if you have a 60,000 square foot Burlington in your power center to right size them to 25,000 square feet. With all the vacancy available, they're likely to move across the street. We expect the pricing to continue to go down on these products at least through the first half of 2021. Then we expect there will be a recovery starting at the year end or in 2022. Things will start to sort themselves out. Most of these are in good locations, so they'll be adaptive reuse to the different boxes. That said, it's going to be painful, and this is the special servicers will be learning a lot of big box tenancy over the next few years. Transferring over to lifestyle centers, there's some similar issues as big box centers, but some additional ones. A lot of the tenants in the lifestyle centers are experiential tenants. So they're gyms, they're movie theaters, they're restaurants. People anticipate that half the theaters in the country will close through the pandemic. No one's certain on that, but if your anchor is a movie theater, you're clearly in trouble. Over 100,000 restaurants have already closed across America. How many of those restaurants come back and what rent can they pay will have a very important influence on the valuation of these lifestyle centers. The lifestyle centers, having reimagined a few of them myself, are very challenging to reconfigure. It's difficult to take a restaurant and make it a medical provider. It's difficult to take a storefront and make it an office space. And it can be done, but it's expensive. As Dan was saying, every price, at some price, everything offers an opportunity. We purchased a center like this at $16 million from bankruptcy during the last downturn and ended up repurposing it and selling it for $40 million right at the top of the market. So there will be great opportunities in this space. It's just not for the faint of heart. As Dan mentioned, there's a lot of money for distressed deals. I believe it's $208 billion raised for distressed real estate. So you really have to know how you're pricing your assets and how you're going forward. And again, the special servicers will be learning a lot about restaurants and gyms and movie theaters that are located in the lifestyle centers they have debt on going forward in the next 2 years. I'd like to move over to the malls. Malls have been getting a lot of attention because they're such a big physical asset, and oftentimes they're the number one taxpayer in a community, and rightly or wrongly, they indicate the direction a community is going. There are, for the CMBS fans, there are $68 billion of CMBS debt on malls across America. That's about 280 malls. These loans were made in 2011, 2012, because the malls looked like a good bet at the time, and they were, and so there's a disproportionate number of malls in a lot of the CMBS pools from those years. So it'll have a big effect on the controlling class and who gets to decide what happens with a pool. There's some portfolios that have 5 mall loans over $100 million in their pools. So malls start losing $50 million in value when they trade or when they get appraised, and all of a sudden you're crashing through many different bond classes. So far, everybody knows about the bankruptcies, Lord & Taylor's, Neiman's, JCPenney's. As these work themselves out, the future is uncertain. So some of these things have to work out before the pricing can recover. So far, there's been very few trades in this product class this year, and those trades have been at very distressed pricing. Bank of America just traded an outlet center that was a $68 million note for $10 million. That's the kind of pain we're going to see going forward. Columbia, Maryland, a mall, Columbia Place in Columbia, Maryland, just got CMBS financing. It was at less than 50% of its appraised value, and the B-piece buyer got 13% on their money for just holding $12 million of that. So there are some challenges going forward. We feel that the malls, at Edge, we feel the malls are a great opportunity. They're 100 acres, 1 million square feet in great locations, and they really have a lot of other uses that can happen to, you can put them to. They can become medical. We've put colleges in them. We've altered them and added movie theaters, which will come back at some level. We've added office space, and all these things will make them the center of the community again. So although there's some pain going to come, we're very optimistic about the direction of these properties as alternate uses. There are going to be a lot less malls going forward. Sort of sum up, we see that single tenant net lease deals are stable or going up. Grocery anchored centers are stable or going up. Power centers, lifestyle centers, and malls are going to have a period of correction, and then they're going to become opportunities for opportunistic investors. Special servicers, our forecast is you'll be very busy.
Yeah, special servicers are definitely very busy. Let me ask you guys a couple questions. And so it sounds like, in summary, but let me clarify this. I want to go to you, Dan, first. So what you portrayed for us, I think, is in general, the hospitality industry will probably go back to what we saw and were like pre-COVID. Whether you're a conference center or you're travel and leisure, or whatever you are, you're probably going to go back to sort of pre-COVID. It's just that it could take all the way till 2025 potentially. Is that sort of right?
Yes, and that's at 30,000 feet, right?
Yes, of course.
Really, the hotel business always has been, always will be a neighborhood street corner business. So it's really going to depend on the asset and the market that it's located in, and the demand that it's attempting to accommodate, right? I think we spoke earlier that leisure traffic is definitely already coming back. People are traveling by car and trying to get away, and some people are actually flying, right? Business travelers are really not traveling, and conventions, group meetings and conventions are just not happening. So that's really going to be the last, to fill, if you will. I do believe that group meetings and conventions will come back, but it's going to be a long slog. And let's face it, I think it's safe to say, I know for the hotel sector, but I think it's safe to say for Barney's sector as well, right? What the world is suffering from today is lack of confidence, right? It's all a confidence game, and once confidence comes back, there's so much pent-up energy out there. Pent-up energy to go travel, to go spend money, to live life, right? I mean, human beings are programmed, to socialize, to travel, to, not to be hermits in a bunker. And I really, maybe I should have been a broker because I'm a little maybe too optimistic, but I really believe when it comes back, it's going to come back swiftly. And really very, very strong. That's again just my humble opinion at a high level. People have short memories. I've been doing this long enough. Seems like everybody on this call has gray hair, so we've all been doing this long enough to have
Mine's
been through.
blonde. Wait. No.
I died, but it's my hair. People have short memories. Think about that slide that I put up about all the oh my God moments in life. And we always get through it. And it's always bigger and better, once we do get through it. So,
well, Dan, one of the things I think that's actually was pretty, optimistic and encouraging is you and I, in fact, are both going to speak. I just saw the list. It's on the same panel at a hotel conference in March, and it's in person. So to think that people are actually scheduling an in-person conference in March, I thought that was pretty nice because I haven't been talking about in-person conferences, So
it's encouraging. There's no doubt about that.
Yeah. So Barney, though, it sounds like, and I hear you. We say retail like it's all. In fact, people do commercial real estate like it's all big one similar product, and it's not. But in general, maybe let's just say malls at this point. Malls aren't likely gonna. It sounds like, I'm trying to just repeat what I heard, aren't necessarily going to for sure all recover. It's just a matter of time. They still have some uncertainty ahead of them, right?
No, we're certain that all malls will not recover. That's the one certainty. There's 1,100 malls in America. Somewhere between 700 and 800 will be something else. So generally, when we work on a mall project, except the outstanding properties like North Park here in Dallas or some other really iconic property, we're selling the opportunity that the mall will become. Because the spike in online sales has devastated the malls. And this was coming before the pandemic. The pandemic just increased the velocity of the correction. Dan's talking about having historical highs before the pandemic. We were at historical lows before the pandemic. Then we just got pushed off the cliff. The fact that, so there's but I think this is the biggest challenge in the business opportunity for commercial real estate. These, 700-800 sites across the country that can be something else. And that whether it's a logistics center for Amazon, it's affordable housing, it's hotels, it's office, they're right in the center of the community with great access. So that's where malls are going.
Okay, so Dan, let me ask you this now too. I'm sorry, yes. There's like a second delay, so I apologize for interrupting. So how do your projections for the future of the hospitality industry, how does the vaccine and the timing of a vaccine or no vaccine, or and the effectiveness of a vaccine, how does that weigh into your projections at all?
Frankly, we don't parse it down to specifically making an assumption about the vaccine. It's more making an assumption that not necessarily that COVID will even go away. I mean, we don't know, right? We may live with this for quite some time. I'm going to go back to, it's all about confidence, right? When people have confidence. I personally don't have confidence to get on an airplane right now. I have not been on an airplane. I haven't been in my office. That's me, right? A whole host of our team is traveling, goes to the office. So it's, and it depends on age and mindset, et cetera, et cetera. I actually didn't realize until the pandemic that I'm in the category of being elderly.
Yeah.
Because I'm over 60 years old, and I never considered myself elderly. But in any event, so listen, God willing, the vaccine is going to work, right? Kind of a step back that we heard, yesterday, that there were some immediate negative reactions in the UK. That's unfortunate. I think we're going to probably, listen, 2 steps forward and 1 back is still 1 ahead, right? Yeah. So hopefully that's what's going to happen. But we are not parsing our analysis specifically to the vaccine and making assumptions about it. It's rather a larger assumption that over time, confidence will return so that people will come out of the bunker.
I agree. Yeah, it's the confidence. I agree with that. So, but yet, Barney, take malls again, just because we're belaboring that. And do you think once people get comfortable going out again and, with this COVID environment, that mall will have all of a sudden a different kind of recovery pattern? Or I would assume it's a little more not dependent on, no matter how comfortable people get in traveling or going out of their home, they're likely still not going to be shopping in malls, I would assume.
So certain malls get a majority of their shopping from tourists. When we travel, we shop 300% more than when we're home. So when the vaccine comes and we have our confidence back, the malls around Miami and Orange County and New York will do much better than they're doing now. But that's a small percentage of the malls. The other malls that are just, in suburban Dallas or outside. I mean, Dallas has 18 malls in DFW. We don't need 18 malls. We've got, for every American, we've got over 20 square feet of retail. Canada's got 4. So we're going to have to make an adjustment, and the malls are going to be the biggest adjuster.
Okay. So I want to encourage everyone to type in your questions. I do have a couple here, and I'm going to ask you both. And this question, I hate to even ask it, but this is what we grapple with every day. How the heck do you value? How do you value? I know you may not be valuation experts, but in essence you are because of your job. But how do you value? Let's go to Barney first. How do you value a mall today? I mean, what would you do to determine its value?
The few malls that have traded, you use existing trades. Few malls that have traded in 2020 were traded based on 2019's NOI with a very high cap rate, 18, 20, 22%. And then, so that's one side of the valuation. The other part of the valuation is we go over each lease in the mall, what we think this tenant will be able to pay once the pandemic is over and they're up and operating again, and we come up with another income stream that we capitalize at a much lower rate. And then finally, we look at the mall and see what else it could be. We're working on a property in the DFW area, and it's clearly an industrial site, and the value is $6 to the land. And so that is going to be the solution for that particular property when it comes to the final resolution. So there's 3 points. One, what NOI was for 2019. 2 is what a scrubbed NOI will be for 2021. Then 3, what's the land value of redevelopment?
Is it kind of the same for lifestyle centers and power centers and the other kinds of retail within reason?
Within reason, they're going to have less. I mean, they're not going to. Lifestyle centers aren't anchored by JCPenney's and Sears, so they're going to lose less total square footage. An example. So you're just backfilling 1 or 2 tenants, and you're a lifestyle center. You had entertainment and different things going forward. So this will not be as, although this will be painful, it will not be as painful on lifestyle centers and power centers.
Okay, and Dan, I'm not going to ask you the exact same question. I'm going to ask you a little bit differently. So what I find as the biggest challenge probably when I'm working with a special servicer on behalf of owners, very first thing the servicer wants to know, and I get it, and we all get it completely, is what does the future look like? I mean, how long of relief do you need? And by the way, they will not look to 2025. I mean, and every location and hotel demand driver, yeah, I appreciate your laugh, but that is what some people think they should maybe ask for and get, but I know absolutely they won't go too far into the future. But the point is, who knows? And so what if they granted relief to 2025 and everything recovered miraculously in 22, you know? So, but the question I was going to ask you, Dan, here is, if you, as an owner, not if you were an owner, as an owner of hotels, how do you possibly project out your own hotel's recovery? And then it leads into, and how do you value it, you know?
Sure. It's a great question. You know, the first thing I'd like to sort of put out there is that, you know, the hospitality industry, both within the hotel operational business and frankly in the real estate side of it, they're an optimistic bunch, right? If you think about the notion of hospitality, right? Hospitality, being hospitable, right? Thinking negatively, acting negatively does not fit well with the notion of hospitality. So basic premise, they tend to be a bunch of optimists, right? And when valuing property, and I do a lot of appraisal work, as you know, of hotel properties all around the country, you know, it's really not what I think. I'm supposed to reflect the marketplace. What is the marketplace thinking? Right? I remember during, you know, not that long ago when people were, you know, folks were characterizing hotel values as frothy. Okay, call them whatever you want. That's the market, right? If you want to describe it as frothy, so be it, but that is the market. So, you know, with that as a backdrop, listen, you know, the fundamental premise of how to value a hotel has not changed. It's still the same premise, which is cash flow, and some more cash flow. And, you know, obviously there's not a whole lot of cash flow there. You know, the notion of cap rates, even when there is cash flow, is kind of a meaningless concept because no hotel owner buys an institutional grade piece of real estate or hotel real estate, slapping a cap rate on in-place cash flow or even projected 1-year cash flow. It's a discounted cash flow analysis. If you think about it, when a hotel sells, what is being sold is the dream of, you know, what can you do with this thing, right? Nobody's buying a hotel for annuity income, steady Eddie income. If you're looking for that, you buy an office building, right? What can be done with this to change it, to reposition it, to rebrand it, to make it bigger, better, whatever, right? And so, you know, here we are with not a whole lot of cash flow. And so what the market, frankly, is doing is underwriting and pricing based on traditional 7 to 10-year holds. Some folks are doing 5-year holds. That's a dicey proposition, but that's another story. And it's frankly looking at an existing asset, sort of like a new facility that's opening up new, because for the most part, businesses starting out at close to zero, right? So building up to a stabilized level of operation, and depending upon the asset and where it's located and the type of business it's going after, it may stabilize in 2 years. It may take 5 years. It could take 6 years to stabilize. I wouldn't be surprised if there's some convention, large, big box hotels in America that might take 7 years to stabilize. By the way, that's, as far as I'm concerned, where the real opportunity will be, in big box convention hotels that are going to take a long time to come back. Because ultimately, if they do become available, they're going to trade at fractions of replacement cost. And if you buy them at the right basis, you can actually afford a couple of years of cash burn and, still be in a 1,000-room asset for $125,000 a room, which is way below replacement cost.
Yeah, it's just amazing, huh? Someone asked if the slide decks can be available after. I don't mean to ask you guys on the spot, but assuming that Dan's okay sharing them and Barney's okay sharing them, we'll certainly send them out to you all after. You guys okay with that?
Absolutely.
Yes, as long as they if they don't want to just send it out, just as if someone requests it, then we'll be happy to send it out.
Okay, great. And I'll send it to the person who asked. And this webinar is recorded, so you can always look at the data there. But anyway, well, I don't have any other questions, so I'm going to ask you guys the last question. And you can just give your parting words, if you will. The biggest challenge, again, is how the heck do we bridge the gap between the reality of the next, call it 5 or 7 years in our world, not just commercial real estate, with the kind of relief we are asking our lender, special servicer, or banker for. And how do you kind of weigh the two? There's a certain period of time we all probably can be comfortable that we're not going to be recovered by. Probably 2021, we still will have issues in all segments, hospitality or retail. 2025, who knows, right? So if you can give any parting words to anybody about sort of how to stay alive through 2025, Dan, if you're an owner, I think that's probably what I'd like you to end with, if you would.
Pray.
Yeah. Boy, amen. Yeah. Buckle up, wild ride. Yeah.
Listen, it's times like these that the seeds are being planted, where we're going to look back 3 to 5 years from now, and fortunes will have been made, right? Think about it. Everybody's loss is somebody else's gain, right? And so there's going to be a lot of pain for existing owners and investors, but it really depends on when did they get into the market, right? Somebody that closed on a deal in December, January, or February, it's going to be a tough haul, right? And if they purchased based on a 3 to 5 year assumed hold, good luck, right? Now that doesn't mean those who invested on a 3 to 5 year hold in 2010, they hit it out of the park, right? But generally speaking, the smart money underwrites and is ready, willing, and if necessary, able to hold for 10 years minimum. And I firmly believe that if you buy at market, it really doesn't depend, it doesn't even matter where in the cycle. If you buy at market and you are prepared to hold for 10 years, it's difficult to lose money.
Great advice. Barney, what are your parting words?
So I've been a lender, I've been an operator, I've been a broker, I've been on all sides of the table through 7 downturns. And through each downturn, the advice to owners of real estate with debt is pretty similar. You understand the values of your property. You're realistic about those values. You're honest and candid with your lender. You present them what the options are. You focus your energy on the places that can make a difference. You know, if you have a portfolio of retail, you look at the portfolio honestly and say, I can make this fix, I can fix this at 50 million, at 100 million basis, I'm dead. And you just have that discussion with your lender straight up and let the chips fall where they may. You end up wasting time and energy lying to yourself or lying to your lender and not just moving forward with what the value of the assets tell you. Right now, you can see the big holders of real estate doing that. They're declaring bankruptcy. They're giving multiple properties back, that they have made the hard critical analysis on what has value and what can recover and what does not. So that would be my advice.
Dan, we can't hear you right at the second, sorry.
I would like to just add, if you consider what Barney just said and tie it over to the hotel sector, you know, I just lost my train of thought when I put the thing on. Anyway, I'm sorry. Go ahead.
No, don't you hate that? Hey, that's part of our being through a bunch of downturns, right? We're still here to talk about it. Well, listen, thank you very much, both, you know, Dan and Barney. I think this has been very helpful. I'm getting a lot of requests for the slides, so I will send them to everyone who asks. And I appreciate your time very much. And we'll look forward. Soon we'll be rolling out the 2021 webinar schedule, so all of you can hopefully sign up for that. But loved having you both. Thank you, and have a great day.
Thank you so much.
Bye-bye.
Thank you for being such a gracious host, Ann.
Thank you.